Listen up, the market isn't some crazy random beast. No, it has a rhythm. It has a pulse. It moves in waves, in cycles. Think of it like the tide. The water comes in, the water goes out. Stocks go up, stocks go down. Your job, your only job as an investor, is to know where we are in that cycle. Why? Because knowing the cycle is the difference between making a bundle, losing your shirt. It's your playbook for victory. It tells you when to be greedy. It tells you when to be fearful. It's the secret map to finding treasure, avoiding the traps, forgetting this is the biggest mistake you can make. People get bullish at the top. People get terrified at the bottom. They do the exact opposite of what they should. It's madness, but not you. After this, you're going to be smarter. You're going to understand the 4 phases that drive everything. Accumulation, uptrend, distribution, downtrend. These 4 stages are the market's DNA. They repeat everywhere. Big markets, small stocks, commodities. Learning to see them is like having a superpower. Alright, let's start at the bottom. The first phase is accumulation. This is the foundation. After a brutal, punishing sell-off, the stock or the whole market has been crushed. The headlines are terrible. Everyone who was going to panic has already sold. Fear is everywhere. Your brother-in-law who was bragging a year ago is now silent. This is the moment of maximum pessimism. Time to start paying very, very close attention. Smart money starts to creep back in. They don't announce it. They buy quietly. They nibble. They accumulate shares from the last of the sellers. On the chart, things look boring. The price goes sideways. It might drift up a little, then fall back. It's a battle between the last sellers and patient buyers. Price action is flat, like a long, boring road. But underneath, ownership is shifting from weak, scared hands into strong, confident hands. A coiled spring getting ready to pop. So what's your signal? Spot the stealthy buying by watching the volume. Look for days when the stock pops up on a big spike in volume. That's a footprint. Then the stock drifts down and the volume dries up. That means few sellers remain. RSI, Relative Strength Index, crawling up from oversold below 30. A CEO saying, "We're seeing stabilization." That's code. The worst is over. Don't jump in with both feet yet. This can take months. It's a test of patience. Do your homework. Identify high-quality companies, strong balance sheets, real earnings. Put them on your watch list. Wait for multiple signs, price stopping new lows, then higher lows. Buyers getting more aggressive. The tide is slowly, silently beginning to turn. Booyah! This is the phase we live for, the uptrend, the markup. The stock breaks out of that boring sideways channel from the accumulation phase. It rockets higher on massive volume. All that quiet buying explodes into the open. Suddenly, everyone wants in. The story changes. The news turns positive. Analysts upgrade to buy. This is the party, and you got here early. Now the public starts to notice. On a chart, this phase is beautiful. Clear higher highs, higher lows. The stock climbs a staircase to heaven. Your simple moving averages, like the 50-day and the 200-day, are now pointing firmly upward. The price is staying comfortably above them. This is your confirmation. The trend is your friend, and right now, it's your best friend. You did your homework in accumulation and bought as the trend was starting. Now, as the trend proves itself, add to your position. Buy the dips. When the stock pulls back a day or two to a key moving average and then bounces, that's your chance to buy more. Volume strong on up days, lighter on down days. Buyers in control. Institutions are holding on and new investors are joining for the ride. But don't get complacent. No tree grows to the sky. Even the strongest uptrends have healthy pullbacks. Your job is to ride the trend, not get bucked off by normal volatility. Use moving averages and the trend line as your guide. As long as higher highs and higher lows continue, stay in your seat. Let your winners run. This is how a nice game becomes a monster home run. Enjoy the ride. Alright, listen closely. Every party has to end. This next phase, distribution, is when the lights start to flicker. The music gets a little weird. The smart money, the institutions, maybe even you, start to quietly head for the exits. On the surface, things still look great. The stock might hit new highs. The news is fantastic. Your cousin finally calls for a tip. The shoeshine boy tells you to buy. When you hear that, a giant alarm bell should be going off in your head. This phase is the mirror image of accumulation. Price churns sideways, often in a wide, volatile range. Ownership transfers again, from strong, smart hands to weak, late-to-the-party hands. Institutions that bought the bottom are now selling, feeding shares to the euphoric public, cashing massive profits, selling into strength. Watch the volume, critical. A struggle at highs, then a lower close on gigantic volume? Churning day. Sellers won. A gap up on good news that finishes negative? Reversal. Big sellers dumping into good news. RSI stuck above 70 is a flashing warning. This is not the time to be a hero. Protect your capital. Huge swings up and down. Volatility is the hallmark of distribution. Buyers and sellers in a fierce tug of war. Your job is not to play. Start taking profits. Sell a little, then a little more. Don't dump all at once. Lighten the load. Raise your stop losses. Protect the glorious profits you made. Don't give it all back. Here it comes. The trapdoor opens. The downtrend, or markdown phase, is where fortunes are lost. Sellers won the battle in distribution and now control the tape. The price breaks below that sideways range, and it breaks hard. All those people who bought at the top are trapped. First reaction, denial. It's just a pullback, it'll come back. But it doesn't. Every rally is sold. The trend has reversed. Now it's lower highs and lower lows. Fear takes over the market. Good news is ignored. The market fixates on the bad. A slight earnings miss that once was shrugged off now sends the stock down 20%. The same analysts shouting, buy, now whisper, hold, sell. The public sells in a panic, often to nobody. The buyers have vanished. Your job in this phase is simple. Defense, defense, defense. If you didn't sell in distribution, sell now. Do not ride a stock down. Your capital is your lifeblood. Protect it. Buying dips in a confirmed downtrend is like catching a falling knife. It's a sucker's game. It might look cheap versus old highs, but it can always get cheaper. The moving averages are your enemy. The 50-day crosses below the 200-day, a dreaded death cross. The best thing in a downtrend is to stand aside. Go to cash. Preserve your firepower. Let the washout happen. Let sellers exhaust themselves. This painful cleanse sets the stage for the cycle to begin again. Survive intact so you're ready for accumulation. That's how you win the long game. Section 6, your toolkit. Spotting the signs like a pro. You can't go into battle without weapons, and you can't navigate cycles without the right tools. You don't need a complex multi-screen setup, just a few simple, powerful indicators. Think of them as your radar. The first and most important tool is volume. Volume is truth. It shows conviction behind a move. A breakout on huge volume is real. A breakout on weak volume is a fake out waiting to happen. Next, moving averages. They're simple, 50-day and 200-day. They show average closing price, smooth the daily craziness, and reveal the underlying trend. Is price above a rising average? Bullish. Below a falling average? Bearish. When price crosses a major MA, pay attention. Trend change often follows. Momentum oscillators, like RSI. Over 70 could be due for a pullback. Below 30 could be ready to bounce. But never use RSI by itself. Overbought can stay overbought in strong uptrends. It's a warning light, not a sell signal. The real magic is combining tools with fundamentals. Know what you own. Are earnings growing? Is the company beating estimates and raising guidance? That's fuel for an uptrend. Are interest rates rising, making business harder? Poison for trend. Breakout plus great earnings is an A-pull buy. Breakdown plus CEO warning is a screaming sell. Tech plus fundamentals is your 1-2 punch. Right, that's your toolkit. Section 7, the buy signal. When to pull the trigger. Okay, let's get down to business. When do you actually hit the buy button? Talk is cheap. Action is what pays the bills. The absolute best time to buy is at the tail end of accumulation or the very beginning of the uptrend. That's where you get the most bang for your buck. You're looking for the moment the stock transitions from boring to bullish. The first major signal is the breakout. It's been stuck in a range for months. Then one day, boom, it closes decisively above the range on volume, at least 50% above average. That's your starting gun. Another classic? Price above a rising 50-day MA. A few days pullback. Stops right at the MA, support, and bounces the next day. Beautiful low-risk entry. It shows the trend is intact and buyers are in control, using the dip to load up. You should too. This is called buying on a pullback to support. Don't forget fundamentals. A technical buy gets turbo boost from good news. Breakout from accumulation base, earnings crush expectations. CEO gives bullish guidance. Bingo, grade A setup. The chart says smart money is buying, and the earnings explain why. When you see that combination, act. Don't hesitate. Don't overthink it. Here's a simple rulebook. Rule number 1. Buy a multi-month base breakout on high volume. Rule 2. Buy the first pullback to a rising 50-day. Rule 3. Confirm fundamentals like stellar earnings. Rule 4. Start small. Don't bet the farm. Add only if action stays strong. Section 8. The sell signal. Taking your profits and running. This is the hardest part for most people. Selling. It's emotional. If the stock is up, you think it goes up forever. Greed. If it's down, you avoid a loss. Hope. Both will destroy you. You need a plan. You need discipline. Start selling in the distribution phase. Stock still high. Warning signs flashing. The first major sell signal. Breakdown of character. A star climber suddenly fails. Can't make a new high. Rolls over, then breaks below the previous low. Pattern broken. Staircase crumbling. The change from higher lows to lower lows is a massive red flag. Sellers are starting to win. Time to sell at least part. Watch that volume. We loved big volume on the way up. We hate it on the way down. A 5% plunge on the heaviest volume in 6 months? That's a fire alarm. A 5-alarm blaze. That's institutional distribution. Big boys dumping shares at any price. Do not argue. Do not try to be a hero. Follow them out the door. The first out gets the best price. Another huge signal. A clean break of the 50-day MA after riding it for the entire uptrend, especially on big volume. That's your exit sign. Sell checklist. Has the pattern of higher lows broken? Yes. Sell some. Broke the 50-day on high volume? Sell more. Company issued a warning or terrible earnings? Sell it all. Protecting your profits is just as important as making them. Don't be a pig. Pigs get slaughtered. Section 9. The Golden Rules. Your shield against disaster. Let's bring it all home. Knowing the cycles is your map, but you still need rules of the road. These are the non-negotiables. The rules that keep you in the game for the long haul. Rule number 1, and it's tattooed on my soul, have a stop loss. Before you buy, know the exact price you'll sell if wrong, maybe 7 or 8%. The number matters less than honoring it. It's your eject button. It prevents small mistakes from becoming catastrophic losses. Rule number 2, diversify. Don't put all your eggs in one basket. I don't care how much you love a stock, anything can happen. Lawsuit, bad launch, crooked CEO. Own at least 5, preferably 10 or more, across industries. If one blows up, it won't blow up your portfolio. Flesh wound, not a mortal blow. Rule number 3, know your time frame. Trader chasing quick scores or investor building long-term wealth? Strategy must match goal. A long-term investor might hold through normal pullbacks. A short-term trader might sell at first weakness. There's no right or wrong. Know who you are. Make a plan and stick with it. Don't let a long-term investment become a short-term trade just because you got scared. Finally, never stop learning. The market is a dynamic, living thing. Patterns repeat, but never exactly. Read books, watch the news, do your homework. The more you learn, the more confident you become. Master the cycle, obey the rules, and you won't just survive, you'll crush it. Now go do your homework. So, are you ready? Are you ready to stop gambling? Are you ready to start investing with a plan? This is your homework. This is your chance to get ahead of the Wall Street wise guys who think you don't know anything. We're going to break down each phase, give you simple, powerful tools to spot them, and clear rules on when to buy, and when to sell. This is your guide to navigating the market's wild ride. Pay attention, because class is in session. The payoff could be huge. Let's make some money. Okay, let's begin. Remember, cycles are your edge. Start your watch list today and take action.